The government runs a survey every 3 years where they ask American families what they have actually saved. The most recent one found that a typical family, headed by someone between 65 and 74, a family that has a retirement account at all, has about $200,000 in it. $200,000. That is the number. Almost nobody says it out loud. Now run the standard advice on it. The old rule says you can safely spend about 4% of your savings each year. 4% of $200,000 is $8,000 a year. That is $667 a month. Add the average Social Security check, about $2,000 a month, and that is the entire plan for millions of people, around $2,600 a month. And this week, the government's own inflation report said prices are up 3.4% over the year, and the average paycheck, after inflation, actually went backwards. So it does not surprise me one bit that the question I get more than any other question is this one. Tim, how much Bitcoin do I actually need to retire? Here is the problem. When you type that question into YouTube, you get two answers, and both of them are useless. The first answer comes from the hype guys. If you do not own one whole Bitcoin, you will die poor. That is not math, that is marketing. The second answer comes from most financial advisors, and the second answer is silence. Zero. Do not touch it. That is not math either. That is a man protecting his license. Today you get the third answer, and I will tell you the strange part right up front. The answer is not a number of coins. It is 4 questions. By the end of this video, you will have your own number, built from your own answers, and you will understand why neither side wants to run this math in front of you. Let's go. Everybody who argues about this question argues about the top of the fraction. How many coins? 1 coin, half a coin, a tenth of a coin. Almost nobody looks at the bottom of the fraction. What is the rest of your retirement made of? Open that $200,000 account and look inside. There are bonds in there. A bond is a promise from a borrower, and the biggest borrower on earth is the United States Treasury. And the Treasury gets its dollars from a system that can always make more dollars. There is cash in there. The Federal Reserve decides how much cash exists, and their answer has never once been less. There are stock funds in there. A company can issue brand new shares anytime the board votes for it, and every new share shrinks yours a little. Maybe there is a house under the plan too. A house comes with a registry that says who owns it, a taxman who visits that registry every year, and, coming soon, a plan to put that registry on digital rails. They call it tokenization. I call it a new wrapper on an old habit. Here's the pattern. Every single thing in that account has an issuer. Somewhere behind every line on your statement, there is a man, or a committee of men, who can make more of it. When they make more, your slice buys less. Nobody voted on it. It is just how the machine runs. Measuring your retirement in dollars is like measuring flour with a rubber band. The mark on the band says 1 cup. But the band stretches a little every year, and the ruler company decides how much. You saw the stretch this very week. Prices up 3.4%. Real paychecks down. You did the work. The measuring tool ate the raise. Now, I built a tool that takes everything I am about to show you and runs it against your own numbers. Your savings, your age, your monthly bills. I will tell you where it lives at the end, because the tool is useless until you have the framework. And the framework starts with the part the salesmen always skip. Before I hand you the framework, I owe you the ugly slide. In 2018, Bitcoin fell 84% from its top. Not a typo, 84. In 2022, it fell 77.5%. And right now, today, it sits about 49% below its record. The record was $126,000, set last October. As I record this, 1 Bitcoin costs about $64,000. I say all of that out loud, first, on purpose. Because if I only showed you the good years, you should not trust a word I say after. And because the drop is not a bug in the plan, the drop is the price of admission. Bitcoin's road has winters the way Minnesota has winters: regular, brutal, and survivable. You do not cancel Minnesota, you buy a coat. So here is sizing rule number one, and it is the foundation everything else stands on. Never own so much that the worst winter makes you quit. Every person who got destroyed in those crashes has the same story. It is never the man who put 3% of his savings in. It is the man who put half his savings in, watched it get cut in half, felt his stomach fall out of his body, and sold the bottom. The size did the damage, not the asset. Your number, whatever it turns out to be, has to be small enough that an 80% winter is a dinner conversation and not a disaster. And for a retired man, there is a second reason this matters. One the young guys on this platform never have to think about. When you are retired, you are not just holding investments. You are selling a little of them every month to live. If a deep winter lands in the same years you are drawing money out, you are forced to sell more shares at worse prices just to pay the same bills, and the account can dig a hole it never climbs out of. The old farmers had a phrase for it: selling the seed corn in a drought. That is the single biggest risk of your retirement decade on any asset, and it is exactly why this framework has a time rule built into it. Hold that thought. It is question 4. Now here is the part almost nobody explains, and it should change how you read every scary headline. When you hear the words Bitcoin crashed, ask one question: what exactly broke? Go back to 2022. What failed? An exchange failed. That exchange was a company with an office and a guy, and the guy is in prison now. Lending desks failed. Those were companies too. Funds that borrowed money to buy more failed. Companies. Every one of those things was a wrapper around Bitcoin, a business with Bitcoin somewhere inside it. You know what did not fail? The thing itself. The Bitcoin ledger has never missed a beat. Through every crash, every winter, every bankruptcy, the network kept writing a new page roughly every 10 minutes, and the supply limit, 21 million coins, never moved by one coin. I made a whole video on this called Your Bitcoin ETF Isn't Bitcoin, and the short version is that the price lives in the wrappers, but the scarcity lives in the protocol. And I will tell you again what I told you last week. When the next big crash comes, I do not think it starts at the Federal Reserve. I think it starts in the AI data centers and the margin calls behind them. And when it comes, watch closely. It will be wrappers breaking. Companies, leverage, not the ledger. Think of it like this. The price is the crowd at the door of the bank. The ledger is the vault. Crowds panic all the time. The vault has never opened for anybody. Why does this matter for sizing? Because the risk you are sizing against depends on what you hold. If you hold Bitcoin itself, with your own keys, in your own custody, your risk is the winter. And winters end. If you hold a wrapper, your risk is the winter plus the company. And companies do not always come back in the spring. The people who held their own coins through 2022 still have every coin. The people who held their coins at that exchange are still in a bankruptcy line, 4 years later, waiting on lawyers. Same storm, very different boats. Size accordingly. And if you want the full walkthrough of holding it yourself, I have a video coming on exactly that. Here it is. The framework. Not a number of coins. 4 questions, answered on paper in this order. This is the loop I opened at the start, and I am paying it now. Question 1. Could you survive a total loss? Write down a dollar amount you could lose completely, all of it, and your retirement date would not move by one day. For a lot of people with $200,000 saved, that is somewhere between $2,000 and $20,000. 1 to 10%. That is your ceiling. Not the hype guy's ceiling, yours. Question 2. Is it big enough to matter? This is the question the advisors never ask, because it cuts the other way. And it rests on the one piece of math that makes this whole decision different from a coin flip. When you buy an asset outright with no borrowed money, your loss has a floor. You can lose what you put in and not $1 more. 100% worst case. But the other side has no ceiling. The gain is not capped at 100%. It is not capped at all. Lopsided bets like that are rare, and when you find one, the smart move is never all or nothing. It is small and real. Watch it work. Say you put in 3%, $6,000. If Bitcoin goes to zero, you lost 3% of your savings. Painful, survivable. Your retirement date does not move. Now run the other side. Fidelity, the same company that may hold your retirement account today, has published a model with Bitcoin around $1 million per coin by 2030. From today's price, that is roughly 15 times your money. Your 6,000 becomes about 90,000. On a $200,000 nest egg, that is not a lottery ticket. That is retirement arriving years early. Run it once more at 5%. $10,000 in. If it dies, you are down 5%, and you are annoyed at me for a year. If the model lands, 10,000 becomes about 150,000, and your nest egg is up 70% from this one decision. Downside, 5. Upside, 70. That is the lopsided shape on paper. But if you only put in 1%, $2,000, then even 15 times your money is 30,000. Nice. Not life-changing. You took the risk without the reward. That is the honest shape of this thing. The answer is a band. Big enough to matter, small enough to survive. For most people, that band lives somewhere between 1 and 10%, and where you sit inside it is yours to choose. Question 3. Decide your trim in advance. Today, while you are calm, write down what you will do if it doubles, if it goes 5 times, if it goes 10 times. Maybe you take your original money off the table at 2. Maybe you sell a quarter at 5. The plan does not matter as much as the timing of the plan. A decision written down on a calm Tuesday will beat your emotions at the top and at the bottom every single time. Greed writes checks at the top. Fear signs surrender papers at the bottom. Paper beats both. Question 4. What is your time horizon? This is the seed corn question from earlier, and here is the payoff. Any money you need to spend in the next 5 years does not go in. Not $1 of it. Bitcoin's winters have run in roughly 4-year rhythms, and you never want a storm and a bill arriving in the same month. The reason the drawdown history does not scare me is the same reason it must never be next year's grocery money. Every one of those winters ended, but only for the people who were never forced to sell in the middle of one. Your Bitcoin, if you choose to hold any, lives in the part of your retirement with the longest fuse. The money for the late innings. The money that, if you were being honest with yourself, might be the part you leave to the kids. That money has the time to ride out a winter. Your electric bill does not. 4 questions. Your ceiling, your floor, your exits, your clock. Answer them, and you have your number. And you will notice nobody had to yell at you about one whole coin. Every live number I have used today, the price, the drawdown, the models, runs on my dashboard at timtalksfinance.com/members. And the core of it is free, no credit card. Now let me show you where a number like 15 times comes from, because I do not deal in magic. Add up everything human beings use to store wealth. Gold, bonds, stocks, real estate, cash in the bank. The researchers who count it put the world's store of value pile at roughly $900 trillion. The investor Mark Moss runs the math this way. If 15 to 20% of that pile migrates onto digital rails and lands on the one asset that cannot be printed, that is roughly $200 trillion divided by 21 million coins, about $10 million per coin. Hal Finney, one of the first people ever to work on Bitcoin, sketched math back in 2009 that landed at 22 million. Fidelity's model says about a million by 2030, and if all of that sounds too far away, here is the nearest rung on the ladder. Gold. All the gold ever mined, sitting in vaults and dresser drawers around the world, is worth somewhere in the neighborhood of $20 trillion. All the Bitcoin in existence is worth about 1.3 trillion. Both are things nobody can print more of. If Bitcoin did nothing in its whole life except grow into gold's neighborhood, that alone is a move measured in multiples, not percents. You do not need the $10 million story for the math to matter. The first rung is enough. Are any of those men right? I do not know. Neither do they. These are not certainties. They are probabilities. And there are no certainties in this business, only probabilities. So let me say the other side out loud, because a man who will not tell you what would make him wrong is a salesman. If adoption stalls, if governments successfully wall it off, if the world decides it does not want a money nobody controls, then Bitcoin stays a niche asset, and those models die on the page. That is a real possibility. I weigh it every week, on camera, in front of you. But notice what has actually been happening. The laws being written in Washington right now are not banning this asset. They are building plumbing for it. The biggest asset managers on earth did not walk away from it. They built products on it. You do not have to believe in $10 million coins. At today's price, you only have to believe that a couple percent of the world's savings goes looking for the exit. Zoom all the way out with me, because this is the real answer under the whole question. They are tokenizing everything. Your bonds, your stocks, the deed to the house. The plan, stated in public, in filings and in law, is to move the world's wealth onto digital rails. And every single token on those rails will have an issuer, a company behind the stablecoin, a registry behind the house, a central bank behind the digital dollar. Every one of them, a man who can make more. Except one. 21 million. Fixed. Forever. No servers, only a protocol. 20,070,000 of those coins already exist today. That is 95.6% of all the Bitcoin there will ever be, already mined, already out. There is no board meeting that can change it. There is no committee. There is no man. So, how much Bitcoin is enough to retire on? Enough that if the repricing happens, you are on the boat and not on the dock. Little enough that if it never happens, your retirement does not move 1 inch. You hold the one asset nobody can print, in a size that lets you sleep, with exits you wrote down on a calm day. That is the whole answer. 4 questions, 1 principle, and no yelling. I built something for exactly this question. It is called the Bitcoin Retirement Analyzer, and it takes your savings, your age, your bills, and your answers to those 4 questions, and it runs the math on your actual life. It is $47, one time. It lives at the same members page, timtalksfinance.com/members, and the command center there is free, no credit card, so you can look around first. I am not here to tell you to buy anything. I am here because you deserved better than a hype man and a silent advisor. Now you have the math they would not run. What you do with it is your call. That has always been the deal here. If this cleared things up, the subscribe button is how you make sure the next one reaches you. Because next, I am walking through what the government's fiscal year ending September 30th could do to the money in your account. And if you thought this report was something, wait until you see that calendar. I will see you in that one.